In Chapter 4, we're going to cover financial services and savings and payment plans. Here are the learning objectives for Chapter 4. I know you can read them, but I will too, to be clear about what we want as takeaways from this chapter. We want to be able to identify commonly used financial services, compare the types of financial institutions, look at various types of savings plans, and various types of payment plans. Various financial services are used to meet daily and long-term financial needs. On a daily basis, common mistakes include overspending, impulse buying, just about everybody does it at some time, not having enough liquid assets, not having enough cash available for an emergency. This is a big one. Paying current expenses out of savings or borrowing to cover current expenses. Failing to earn interest on unneeded liquid assets. So where can you get quick cash when you need it? You could take it out of savings or cash in a CD or mutual fund shares, or you could borrow the money. The problem is either of those options reduces your net worth. Remember back in Chapter 2, we're trying to increase our net worth. So what types of financial services are available? On the savings side, we've got time deposits with savings and CDs. On the payment services side, we've got checking accounts, which are demand deposits. We can set up automatic payments through your bank as well. We can borrow for either short or long term. And there's other specialty services, insurance, investments, real estate, tax assistance. We're going to be looking at a lot of those in the coming chapters. An asset management account is a very popular type of investment account, also called a cash management account. It typically includes checking, ATM, credit card, online banking, a line of credit, and investment access. In the Memphis area, several different companies offer these. Duncan Williams Asset Management, Southeastern, UBS, Longley Partners, Region Bank offers it. Online banking nowadays is offered by virtually all large commercial banks and many credit unions. Does anyone actually get a paper paycheck anymore? Direct deposit is so much more convenient for you and for your employer, and the money's in your account immediately on payday. You can set up automatic payments and reminders for recurring bills, light, gas, and water, a car note, or a home mortgage payment. You can set up an automatic savings plan that transfers a set amount to a savings account every week or month, almost as good as having it taken out of your paycheck before you get it. And it's a pretty painless way to begin saving. Everyone needs cash from an ATM periodically. Using your own bank's ATM is usually free. Using other ATMs can carry a fee. Debit cards can help overspenders get control. No money in your account, you can't buy anything, period. The downside to a debit card is it builds no credit record, as we'll see in Chapter 5. The next step from online banking, and really not much of a leap, is mobile banking. Most large banks have mobile apps available, and as with online banking, only more so, there are issues of privacy and security. My bank, Regions, offers mobile check deposit, but there's a fee. It's $3 for overnight processing, anywhere from 1 to 3% of the check amount, minimum $5 for immediate availability. This slide just recaps the services available online and via mobile banking. Under payments and transfers, the newest option is the next to last one, using your phone to make a purchase. Apple Pay, Samsung Pay, Android Pay. By the way, research has found that using your phone to pay is faster than a chipped card and more secure. Deposits online are still a bit tricky and may incur a fee, but most other services are free and readily available. The pros and cons of online banking. The major pros are convenience. Your online bank is available 24/7 and provides a full record of all your transactions. The cons, as with anything online, privacy and security are always issues. The other main con is the difficulty of making deposits of cash or checks. Interest rates, the cost of money. If you're borrowing, low is good. If you're saving, high is good. Either way, you need to be aware of what current rates are and what's expected. As of 12/13/2016, the national averages were for a 30-year fixed mortgage, 4.52, for a 15-year, 3.18, 5-year CD, 1.22%, 2-year CD 0.77%, 1-year CD 0.58%. For a loan on a new car, 60 months 3.06, 48 months 3.01, 36 months used car 3.30. The prime rate, which is kind of the benchmark rate, on that same date was 3.5% as a reference. Watching current rates and expected directions helps you make smart financial decisions. If rates are expected to rise, long-term borrowing, lock in the low rates. Short-term savings, wait for the higher rates. If they're expected to fall, you do the opposite. Comparing financial institutions is a personal decision. Depends on which services you need, which you'll use the most, and what's important to you. High return on your savings, minimum cost for services, availability of loans. If you're choosing a new bank or financial services firm, think through clearly what you need and which services are important. Convenience can play a big role. Is there a branch near your home or office? Regardless of how attractive the features, banking a long distance away can be more trouble than it's worth. Do at least compare 2 or 3 institutions to get a feel of how they stack up. Once you have a clear picture of what you're looking for in a financial institution, check out the options. Don't neglect smaller local banks. They can offer very attractive rates and hometown services. Ask friends whose opinions you trust where they bank and are they happy. A personal visit to a branch can give you a good feel on how you'll be treated as a customer. Here's some suggested items to be sure you cover in your research. What services they offer, complete disclosure on their fees, do you need to maintain a minimum balance, what's their savings rates, sample loan application, do they have sufficient deposit insurance? So, in looking for a financial institution, what types are out there? Deposit institutions, as the name implies, they take deposits. Commercial banks are the most common. They're organized as corporations. They typically offer a full range of services, deposits, loans, and investments. Savings and loan associations, or S&Ls, not that many of them left after the S&L crisis in the 80s and 90s. They're generally operated like commercial banks, but their primary focus is on home mortgage loans. Mutual savings banks, not many of these around either. Northwestern Mutual, the insurance company, has a mutual bank subsidiary. The key point is the bank is owned by the depositors. Credit unions are user-owned. They're nonprofit, they have lower fees and rates, and they're typically associated with a business or organization. There's a Teachers Association Credit Union, Navy-Memphis Credit Union, Federal Express Credit Union. The term financial institutions also includes non-depository firms, life insurance companies. Some of these also offer savings and investment programs as well as financial planning services. Investment companies offer mutual funds and money market funds, but these are not covered by the FDIC. Brokerage firms also act as non-depository institutions. Credit card companies offer short-term loans. Finance companies offer short and medium-term loans. Mortgage companies provide, what do you think, home mortgages. A few financial options are, to say the least, problematic. Pawn shops. They are a source of quick cash for possessions, but the fees are high. Check cashing outlets, they're also known as currency exchanges, charge a fee on the face value of the check. Payday loan companies, they offer cash and check advances, very high interest rates. Rent-to-own centers, really leasing you merchandise at a high interest rate. And car title loans, do I need to explain this one? The maximum car title loan in both Tennessee and Mississippi is $2,500. So let's move to savings accounts. Regular so-called passbook savings is the most common. There's virtually no minimum balance, but a very low rate of return. Easy withdrawal, and it's insured. Most of us probably started with a savings account as children. CDs, or certificates of deposit, are typically time deposits in the sense that there's a time on it and a penalty for early withdrawal. There is also usually a minimum deposit. A wide variety of types to fit all needs, offered with usually higher rates for longer terms. Many banks also offer interest-earning checking accounts or preferred accounts, though these typically require a minimum balance at all times. Money market accounts and money market funds pay a floating interest rate and do require a minimum balance. Note, money market accounts are insured by the FDIC. Funds are not. U.S. savings bonds, frequently bought as gifts for children. These are the original zero-coupon bonds. They're sold at half of face value, they pay a fixed rate, and they can earn interest for up to 30 years. Series HH bonds are unfortunately no longer sold. I bonds are indexed. They pay a fixed rate plus an inflation premium adjusted twice a year. All Treasury securities, savings bonds, T-bills, Treasury bonds are available for sale to individuals online via Treasury Direct. This chart is in your text and outlines an approach to evaluating savings plans. You want more liquidity? Left-hand leg, money market accounts and funds and their pros and cons. Less liquidity? Right-hand leg, CDs, or savings bonds is the bottom alternative. Here are the 6 criteria for selecting a savings vehicle. Rate of return. Inflation makes fixed rate interest earned worth less. Taxes reduces earnings. Liquidity. How fast can you raise cash? Safety, risk and insurance, restrictions and fees. Minimum balance requirements are the most common and can vary widely, as can fees for additional services. We're going to look at each of these criteria briefly on the following slides. For savings plans, rate of return can be critical. Rate of return, or yield, means the percentage increase due to interest earned on interest, compounding. As we looked at in reviewing time value of money, more frequent compounding increases the future value. Annual yield for 4% annually is 4.8 if compounded daily. And as should be obvious, a higher interest rate is a higher future value. The Truth in Savings Act requires that both lenders and depository institutions disclose the interest rate paid or charged in a specific format: APY, annual percentage yield, APR, annual percentage rate. In either case, the rate is the periodic rate times the number of periods per year. So if a lender charges 5% per month, the APR is 5% times 12, or 60%, and that's the rate that must be quoted. Inflation reduces the value of interest earned. In evaluating returns, compare them to the rate of inflation, current and expected. Taxes, like inflation, taxes reduce interest earned to after tax. The higher your tax bracket, the higher the hit. Liquidity has 2 dimensions, equally important. The ability to convert an asset to cash quickly. Emphasize this, without significant loss in value. You can sell anything quickly if the price is low enough, so the second dimension is critical. Safety. FDIC insures up to $250,000 per person per institution. NCUA, the National Credit Union Administration, covers credit union accounts. And restrictions and fees. As mentioned, minimum balance requirements are by far the most common. There are some types of accounts that charge by transaction or by check written. Now let's look at payment methods. This chart compares 3 general payment methods: electronic, debit or credit cards, online payments, prepaid store cards, and smart cards, a checking account, handwritten, other, cashiers and certified checks, money orders, traveler's checks. We're going to look at each method. Debit card transactions. We've already talked some about these. It's an immediate deduction from the linked account, but it builds no credit history. Online payments. PayPal has definitely changed online buying by offering a safe way to transact with people and companies without really knowing them. What started with eBay has expanded so that many online retailers accept PayPal. Even some academic journals accept PayPal for renewals. Stored value cards are basically prepaid cards. Telephones and tolls are common. Gift cards fall in this category. Smart cards. We're moving in this direction with the edict to provide chipped cards. And finally, peer-to-peer payments. This allows the direct transfer of funds from your bank account or credit card to another person. PayPal and Google Wallet offer that. The credit card versus debit card debate. Using a credit card makes sense if you want to delay payment, you need to build a credit history, you're buying online, it's a major purchase, you want to earn rewards, or you need it to rent a car or book a hotel room. Use a debit card if you want to control your spending, avoid future bills, avoid interest, better protection. About checking accounts. Regular checking accounts. For years, this was the standard way to pay monthly bills. Write a check and mail it. A minimum balance is usually required to avoid monthly charges. Still, Having the ability to write a check is sometimes required unless you choose to deal 100% in cash or credit. Activity accounts. These are low-activity checking accounts with a fee charged for each check written. If you just need a basic account, don't want to maintain a minimum balance, and write very few checks, this could work for you. Interest-earning accounts or share draft accounts at credit unions. These require a minimum balance, but they do pay a very low rate of interest on the balance. We've covered looking at restrictions and fees. Consider overdraft protection if you typically maintain a low balance and want to avoid overdraft charges, which can be hefty. Beware, though, of package deals. You don't want to sign up for more than you need. You might end up paying for it. From the text, this is a chart recapping the decision criteria for selecting a checking account. You probably want to pay particular attention to a minimum balance requirement, any monthly fees, the availability of ATMs in convenient locations, and what interest rate they pay. Other payment methods, certified and cashier's check, both include guaranteed payment for a fee unless you have a preferred account with the bank. Money orders are purchased from a post office and in many stores. And traveler's checks. They used to require double signing, once at the time they were issued, again when used. They're not used much now since credit cards are widely accepted all over the world, and if you do buy a traveler's check type item, it's actually issued in credit card form, usable at ATMs. Assume you decide you do need a checking account. Opening the account. Individual, your name only. Joint. Be careful of and, use or. It can be a spouse or a parent. When you're making deposits, 3 types of endorsements. A blank endorsement. You just sign it. It's negotiable by anybody if you lose it. So this is the one you'd use if you're right there at the bank depositing it. Restrictive. Deposit only with an account number. Special. Pay to the order of. That transfers the check to a third party. Frequently, these are not accepted. Writing checks. What do you record? The date, who you wrote it to, the amount in figures, the amount in words. You sign it. You should note down there there's a line for. Note what it was for. Reconciling your bank statement. First thing you need to do, compare your record of checks written against the list of checks cleared on your bank statement and subtract checks written but not yet cleared. Then add deposits not shown on your statement, subtract any fees or charges and any ATM withdrawals, and finally, add any interest to your checkbook total. This should balance your checking account. If it doesn't, go back and recheck everything. If it still doesn't, contact your bank if you can't find the discrepancy. We'll walk through a bank reconciliation example. Will is balancing his checkbook. His online balance is $1,250. His spreadsheet balance is $450. Outstanding checks on the worksheet not cleared, $795.50. Online interest, 50 cents. Online rewards credits, $4. Does he balance? His online balance minus uncleared checks, $1,250 minus $795.50, is $454.50. If he adds his interest and rewards to the spreadsheet, he's balanced. Summarizing the chapter, these slides go over the 4 learning objectives. I'm not going to go through all of them again, but I will pass through them here at the end just as a review. Learning Objective 1, identify commonly used financial services. We covered the basic one here. Savings, checking, loans, trust, which we'll cover in Chapter 14, electronic banking. Learning Objective 2, compare the types of financial institutions. We covered a variety of financial institutions and the criteria to compare them. Learning Objective 3, recaps types of savings plans and the criteria for evaluation. Objective 4, we covered basic payment plans, the most common being debit and credit cards and regular checking accounts. This concludes Chapter 4. Work the end of chapter problems in Connect to be sure you're comfortable with the material.